Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, it's Friday afternoon, and we're seeing another options expiration rate in gold and silver that we've been anticipating. Silver down nearly about $1 actually over the last 48 hours. Today, touching about $14.70 right now as we record early afternoon. Gold trading down nearly to $12.10, but has bounced a little bit more than silver here. What do you think is next over the next week or two for gold and silver? Do you think there's any chance that we see the cartel be able to push gold down towards its 200-day moving average?
Well, the operative word is toward. Yes, I think that we can see some downside action, but I certainly don't think that they're going to be able to get it down to, 200-day moving average is below 1,140 gold, and that's a level that will elicit a gigantic amount of buying, both from the paper traders and from the physical market all over the world, and it'll even pick up as well in Western markets. I mean, we were seeing, we incorrectly reported the magnitude of, but nonetheless, we were seeing a lot of action in, for example, London, and physical market responses in a Western market to what's going on at a level that, is a little surprising because, frankly, most people have just been operating on the assumption that the powers that be would be able to, resuscitate the economy, bring us into some kind of a, decent growth trajectory for 2016, and we had all this fantasy talk, in the whole fourth quarter of 2015 about interest rate normalization and on, that could only have happened with, people in the financial markets looking the other way and believing the nonsense that was being served up by our policymakers and the central bankers and so forth. Now we're here where quite literally the character of the gold market, the silver market as well, has changed. There are new buyers here that are present, and they're interested in buying these dips, and they understand that we are now long in the tooth of where we are economically, and even those that may not agree with the thesis that we are already in a standard equities bear market cycle, nonetheless, there's a heck of a lot of far greater trepidation about what's going on, even among the conventional financial community that manages the vast majority of money under management in Western financial markets. So with all of that as backdrop, and the fact that this deflationary cycle that's taking over financial markets and imploding like some low-grade fire that spikes out of control periodically in this shadow banking system with its highest problematic bank, struggling banks in Europe. I mean, we know what's going on. We can see it. And it's even now, as crazy as things have become, it's even openly discussed by people at the very top of the financial community. So these are not, conspiracy theories. We have people like Mr. White, former chief economist at the Bank for International Settlements in January, talking about things at a level of honesty that are just downright shocking. The Bank of the former governor of the Dallas Fed, Fisher, as well. He, said some pretty amazing things in December. So it's not like, the rats aren't jumping ship and speaking to what is actually going on. You just need to know where to look, because they do communicate with everybody else. It's kind of like they're attempting to shape the way policy consensus is established, and they're attempting to, the more honest people among the banking policy community are attempting to bring a little sunshine into this discussion, because what has been going on has been absolutely, totally, utterly insane. this fantasy world of this Keynesian prescription for trying to fix broken bubbles with new bubbles and fix debt insolvency and crises that are growing out of the oversaturation of our financial markets first and foremost, but even the general economy and the real economy as well is being overladen with debt. You cannot fix a debt problem with adding more debt. So all of these macroeconomic, global macro kind of trends are becoming more well understood by the participants in our financial markets, and that is the understanding that's going to prevent this kind of Goldman Sachs in the last 2 weeks has been doing this nonsense about for initially they were saying that gold would probably go a little bit higher, and then all of a sudden when it starts moving a lot higher and getting out of control, they talk it down the market they're turning to their Muppet clients and presumably trying to make the case that they should sell because they were targeting 1,000 gold within the last 2 weeks or so of them hitting the talking circuit, the TV, financial press, etc., with that kind of a call, and the press is very enthusiastic to in fact parrot the call because their interests are served. So it's a long rant, but I think the context is actually important to really understand what is the background conditions that in fact do point to the character of the precious metals market being very different today. It's not some kind of pie in the sky assessment. It's really what's happening, and that's why we had this huge move. I mean, we have gone from December lows of 10.45 and 40 cents on a spot basis for gold, all the way up to 12.37 spot yesterday. That's intraday today. Yesterday, 12.54 and 30 cents yesterday. That's a pretty big move, and we saw yesterday as well that kind of pattern that we jokingly describe as either the sombrero or the witch hat, where in silver we initially midday through London trading we had a pretty decent move up and then went sideways for the rest of the London trade all the way through to the New York Open, and then COMEX comes in and all the paper guys come in and they push silver up a lot. We went from about 15.30 give or take to about 15.45 give or take, and then we go down a little bit with normal profit taking. That's not cartel action in my opinion. And then we peak out about 15.50. And then again, normal profit taking, and then all of a sudden, because the momentum is fading, this is a thesis that we presented on our show many, many times of how the cartel actually operates. More often than not, they don't actually like to go after a speeding train because an object in motion is harder to slow down because of the momentum. It's not, it's just basic physics, and I'm using a metaphor from physics to describe what's going on in the financial markets. The line of people lining up waiting to buy was partially satiated, or at least reached a level that in fact elicited normal profit taking. 15.50 exceeded on silver triggered normal profit taking. That's exactly what you would expect to see in a normal market move. And then we faded down a little bit, and then through today, the markets were taken down further. Through the close yesterday, the normal session in the New York market, and then all the way through, we still see some pressure. And then that raid this morning is, something that speaks to that too. So.
And we didn't publish your comments, but Eric saw this coming, and he wrote out some private comments that he sent to myself and a few regular SD readers, and really you could see it coming. I felt the same yesterday.
Yeah, and really what matters most is, what is going to happen on a going forward basis. We did the show last week with Steve, and it was really long in the tooth of the moves that had happened already, so we were very vulnerable from a momentum point of view. And from, on a short-term basis, you get the technical traders a little bit nervous because you end up getting high momentum overbought signals coming to those trading desks, and those guys are a little edgy. But the cartel attacked on Monday, and they went after silver very aggressively, and we recovered out of that very quickly. And that also speaks to what I was describing before about this underlying change in the market. And we've seen that pattern a couple of times, actually, in the last 6 weeks or so, the duration move that started mid-January through to today. And we're seeing a little bit of a move today that shows some attempts for stabilizing, and buyers are in the silver market are stepping up and at 1465 or so and coming in, and we see what looks like an attempt to try to recapture some lost ground over the last day. But it's probably not enough to, and we're recording this, we got a couple hours left of the normal session, then the after-hour session later on Friday. And I suspect that is actually going to tell us to some extent what the character of the market will be next week, because if we see some firming up, maybe if we recover half of the loss, so to speak, that'll indicate, again, that there's a lot of buyers out here looking to buy dips, and though the damage was really significant and it's going to take some time to recover next week, I still think that we have a pretty decent chance here of later today actually getting confirmation before this actually goes live. So I'm making these comments and without any fear of the cartel, listening to the most listened to precious metals podcast in the world, and actually saying, okay, this is what people out here are going to be hearing and thinking, so let's screw with them. I mean, that kind of thing happens occasionally too, and we're aware of that. It's one of the reasons why I didn't publish what I saw yesterday. Frankly, is I didn't want to put out that kind of a foil that they could target.
Into the physical side, it's rather amazing to me what we've witnessed here in the first 2 months of 2016 without any of the real panic in the market like we had in Q3. If you look at the U.S. Mint, we're still in February, and they've sold an even 10 million coins already. I mean, that's on pace to exceed 60 million coins for 2016 if they can keep the presses running for 12 months, which is probably not likely that they'll do that, but if they did, they're on pace for over 60 million. Another thing that's been quite amazing, really, with about a week or two of consolidation, not outside of today, not too many real big movements either to the upside or the downside in gold and silver, is that backdated gold eagles, which typically trade at a pretty significant discount to the current year coins on the wholesale market, they've been pretty much non-existent or selling, and when they are existent, the wholesale dealers are selling them for more than the U.S. Mint charges for new coins, which is something I haven't seen going back the last 5 to 8 years, outside of maybe once or twice when we saw, like for a few days after gold broke down to its 5 or 6 year lows, and the market just sold out of everything and everything got tight and things like that. So it's really highly unusual that you're not seeing any backdated gold eagles on the market. It just shows you the level of investor demand that there is across the retail market for gold right now, as well as silver.
What have you been seeing as far as premiums? Anything interesting there?
Premiums haven't made a major move to the upside yet. They've pretty much been steady, slightly above what I would say of levels prior to last summer. Probably about maybe 15 cents an ounce across most products, higher. But things have been getting tighter even before today's smashdown, which I expect the market to be quite a bit tighter in silver next week. So as of yesterday, quite a few of the authorized purchasers, the U.S. Mint authorized purchasers of Silver Eagles, are still about 2 weeks sold out, or 2 weeks back on Silver Eagles, basically meaning that they've already sold forward their anticipated next 2 weeks allocations from the U.S. Mint. The U.S. Mint is still allocating the number of coins that the authorized purchasers can purchase each week. So basically each Monday they have a certain number that they expect to be able to purchase. So assuming the U.S. Mint actually gives them that many coins in the next 2 Mondays, quite a few of the APs are already selling for basically 3 weeks out delivery.
Wow.
Meaning that you place an order right now and send your $400,000 bank wire today, and you'll have coin ship in 3 weeks. So they've already sold forward their anticipated allocations from the U.S. Mint over the next couple of weeks. and that's before the big move down today. So I expect the market to be a bit tighter next week, and really it's quite amazing with gold and silver prices up over the last couple of weeks and kind of consolidating here. So
it's very interesting. And just for the amusement of our listeners, this is actually the first time I've come across this information, because Doc and I haven't talked about any of this stuff, and I haven't had the time to follow what's going on in the coin world and so forth. And that delayed reaction is really interesting, because it's counter to where the market would make most people think. You'd see silver getting lionized today and so forth. And you'd imagine that immediately or very soon the pressure would actually loosen up. And because of what's been going on with the allocation on an ongoing basis and the supply chain being stressed overall, that actually sets up an assist, so to speak, from the physical buyers that are stepping up to the plate and buying. I mean, the mint is in allocation for a darn good reason. And that sometimes, well, the whole, the process by which the supply chain responds with a lag, as you just described, is fascinating. And I think that's one of the things that makes the show interesting, is because even I learn from it. So.
Put that in perspective, I mean, zooming out a couple of years, I mean, last June, when the whole the Greece crisis rose its ugly head once again, and the U.S. Mint sold out in 24 hours what they thought was a few months stockpile, and they stopped selling Silver Eagles for, it was about 3.5 weeks, and they resumed sales in July. They've been on allocation ever since. There's not been one day since then that they've been off of allocation. So ever since then, they've been allocating coins to the dealers. That means their authorized purchasers basically get rationed amounts that they can purchase each week. It means that the U.S. Mint does not consider any new applicants to become authorized purchasers. It's really unprecedented to see that long of an allocation.
Yeah.
Usually it doesn't continue indefinitely. Usually there'll be historically, even over the 15-year bull market with the 5-year correction here, the Mint would occasionally run out of coins. They'd shut down sales for a month. They'd come back and they'd allocate coins for 3 or 4 weeks, and they'd be back to business as usual, and the wholesalers and the APs could buy as many coins as they want. But we've never seen a period of going on 10 months here of just nonstop rationing.
Yeah, that's a really important point. When I think back on the shift that we had in starting around September 2011, which is roughly when the whole sort of phase down of this bear cycle that we've been laboring through started, that's when we began to see occasionally, and with every passing year, even more crazy histrionic machinations from the Fed the Mint when it comes to the allocation, as well as even just outright suspending of sales of current year because they were getting close to the next year. Prior to 2011, both of those kind of things never were happening at all, ever, with the exception of just normal die changeover shifts at the Mint where, sometime in December they'd go offline, and that's normal. Now we're living in a completely different world.
Yeah, and just one further anecdote about the physical inventories is the registered stocks in the COMEX. The registered or deliverable silver inventories in the COMEX hit an all-time low back in the third quarter of 2011, just above 25 million ounces. And over the next 4 years, they really almost tripled from that 25 million ounce level up to about 72 million ounces, which was seen last April 2015. The inventories had built back up to over 70 million ounces. As of today, here at the end of February, and I mean we're talking 10 months later, COMEX registered silver inventory is back to all-time historic lows of just over 25 million ounces. I mean, it's nearly a 70% decline in less than 12 months.
Yeah. And
again, those are 1,000-ounce bars we're talking. We're not just talking generic coins or coins. Lots of times the skeptics will try to make a discrepancy between the retail market and say, oh, that doesn't really mean a shortage. It's just a shortage in fabrication. But that's showing even the 1,000-ounce bar market has been substantially drained over the past 10 months.
Yeah, and the whole shift to the pattern of what the U.S. Mint does as well is so profound and so large that it just can't be explained away. We're living in a completely different in supply chain management paradigm since 2011, just based on the prima facie changes that they employ. So, this is not, oh, gee, we need to delay whether or not we're going to do some purchases for our capital equipment for mint presses, etc. Yeah, that's a factor, of course, but the real driver going on here, that largely explains the majority of what's going on, is that there's just not enough silver to service the retail demand, and they're terrified of that.
25 million ounces, that's not much more room. I mean, just 2 days ago, it lost another 3.6 million ounces in a single day. So you see much more
over on COMEX. Yeah.
Right. So you see many more declines like that, and COMEX will effectively be out as far as any inventory reservoir. You're going to have to source it either from the scrap market or directly from the mines.
Yeah, or just call out a 2013 April style raid and try to really beat the heck out of the markets, and that may come. But frankly, I don't see how they're going to get a lot of traction. That be like that 2013 raid in April. People sometimes forget what happened in the 2 months that followed. We had 100. What was it? I'm trying to remember the exact tons. I believe it was 104 metric tons being purchased by India officially in the following month. And that was just the official number. If you added on all of the unofficial stuff from smuggling and so forth, it was a lot higher than that. And the same kind of thing happened in China, too. I don't remember the numbers off the top of my head, but that's the kind of stuff that would actually be elicited by a mega cartel raid, an effort to truly resuscitate their game playing. And, that gets back to your opening question about the gold 200-day moving average. Even if they were able to get down to that level, even that level plus $10, never mind hitting it, I think that they would just create a complete firestorm of demand. So this is like once again the perfect storm and description of the reality of the fact that more people are waking up to the financial markets rolling over. Standard equity markets is in a slow motion bear market phase that is easy to deny, at least by some people, and bond markets ridiculously overvalued. And then on top of all of that, we have the shadow banking system crisis that's going on that literally will be the link that is weakest in this chain of potential energy that can really send precious metals much higher as people seek an honest and true safe haven bid. And it won't take much for an additional percentage of this conventional financial world pile of money that's hanging around and starting to get very, very scared to see precious metals move higher and reverse any kind of cartel raid. So I look at all this kind of stuff on a short-term basis with, silver being attacked viciously today. And it's kind of like, we've seen this before. And at some point next week, it's going to shift around. We already see the standard equity market in the United States trading right now, just kind of like fading after the resuscitation efforts of yesterday and today. We saw oil targeted in the last 2 days for resuscitation by manipulators, in my opinion. I can't prove that, but I think that that's what is partially going on with oil. I mean, it had a reaction to the inventory numbers that are reported on a weekly basis for the United States market, and there was less of an inventory build than expected. And people have been actually rightfully nervous about the level of inventories on hand because we're getting so high that it's beginning to get priced into the market a scenario where people assume that it's a decent probability that we'll just simply run out of storage on a short-term basis, and that would send a lot more oil into the market as a result, which would end up pushing oil conceivably even below $20 on a West Texas Intermediate quote. And that kind of deflationary impacts to the global economy, because it does translate in a roundabout way into actual deflation, because it hurts the balance sheets of financial institutions and other companies as well, as the underlying collateral for the portfolio of assets that are held by a mid-tier oil company is the basis by which they can make loans or take out loans. Excuse me. And that puts pressure on literally the collateral of the real economy. And then in turn, as the price of oil falls, the cash flow that comes from sale of oil that's being produced by these impaired oil companies is less able to service the debt that they have, and you end up getting a kind of feedback loop that creates a deflationary effect in the economy driven out of financial market mechanics. And so it's very important for these stewards of our financial markets and our real economy, the policymakers and the Bank of International Settlements, all the way down to each central bank of material size, and the associated treasury departments and all those people, and how they link up to all this stuff. And all of them are all interested in managing markets, because the instability of the kind of markets we have now today are a direct result of the past manipulation of markets. It's like this kind of clusterfuck. It's been created by economic policy that just has been completely unhinged from reality. And now the honest central bankers and policymakers among the crowd are really willing to speak out about what's going on, because of the level of insanity that this whole cycle has reached, of exploding bubbles and reflation of the financial sector in hopes of inflating the real economy in turn. And that is but in fact the exact process that we've been going through very clearly since the NASDAQ crash of 2000 March. Bubble after bubble, and they blow up and they try to reflate them.
Eric, I'm going to put you in the spot here a little bit. We haven't talked about this before the show. Over the last couple of years, gold has pretty much been tied at the hip to the yen. If you take a look at the gold chart, put it over a yen chart, the correlation is probably higher than 0.9. As this bull market gets underway and gets legs, do you see gold breaking away from that tie?
Yeah, absolutely. In fact, a lot of people ascribe it as being a direct causal relationship, and I think that sometimes that is indeed operative. However, I think it's also an artifact. This is at the same time, and again, folks, it's very easy to fall into binary style thinking, and that usually is not the way to understand, particularly in financial markets and the nature of financial markets. There's multifaceted, forces going on here. It's a multifaceted kind of dynamic, as opposed to some kind of linear relationship that's being expressed with yen, gold, and how it links up with the dollar. It's shaped by the whole rotation that we've been going through with the currency wars, how the currency wars fit into economic policy and the reflation of markets overall. We have seen a very clear pattern of, as Jim Rickards actually describes it, passing the canteen, and each central bank taking a big swig of the currency war canteen. And this whole cycle of many years of the yen, just falling, and then that having a direct link to the gold expression of market movements and monies and flows, frankly, is not the same as it was over the lion's share of the pattern that was clearly operating, because we're beginning to see, for example, a change in the way in which the dollar is going to be managed around the edges, simultaneously happening with the U.S. economy turning down at a degree and magnitude that can no longer be denied. And all of these multi-faceted dynamics shaping on a global macro front with respect to these deflationary trends, with the impacts of the prime three drivers, frankly, for the inflation the three drivers for the deflationary trend, being the crash in oil prices, the problems with third world countries servicing dollar-denominated debt, and the rise of the dollar. That was a huge problem earlier, and now it actually is not as much of a problem because the dollar's moonshoot is stopped. So, and then the third one that we've described off and on as well too, being dollar and oil. And then the other deflationary, dynamic coming out of just the generic problems in the shadow banking system in Europe. All these things are reverberating around and creating a kind of a cycle, a trend that's really hard to fight from the economic policy wonk point of view. And as a result, this is a really long-winded explanation and description of the kind of factors that are shaping what will ultimately show up and influence that dynamic we saw with the yen and the gold trade and change it. And I think we're already beginning to see some of those changes happen. It's not going to happen overnight. It's going to be an evolutionary kind of thing. So I wouldn't put as much emphasis on what happens with the yen vis-a-vis gold and precious metals overall, because the dollar is also going to be under pressure by design, because it just has to come under pressure, because that's the logical conclusion of what policymakers will conclude. Because if they don't attempt to keep the dollar under wraps and attempt to address these deflationary cycles that are growing out of, say, for example, oil or the dollar with dollar-denominated debt, the whole system can blow. And it's now time for the United States dollar and the U.S. policymakers to grab the canteen and take a swig. So all this interest rate normalization nonsense that we heard throughout all of the fourth quarter, as loud as it came, we don't hear that anymore. We already heard the trial balloon from Yellen a couple weeks back when she was doing her testimony to Congress about possibility of negative interest rates as a hypothetical concept that the Fed even considers, even to this day, when it was only mid-December that they were raising or trying to raise interest rates. So, long-winded explanation, but all of that is relevant to understanding what's going to happen in Japanese yen vis-a-vis gold. And I think that was, it's almost like, the old saying in the financial markets as well as in war, generals tend to fight the last war. And I think conditions are changing to so much of an extent that that dynamic will also be changing in 6 months from now. People will be looking at it and saying, well, okay, that changed. But time will tell, and I may be completely wrong, but that's my best assessment of what's going on and the answer to your question.
Yeah, it'll be interesting to see whether that just gradually changes or whether it takes something like a drastic about-face reversal in U.S. Fiscal policy, or the Fed's fiscal policy, and going from tapering, say, to NERP or more QE.
Yeah, well, the financial markets are definitely driving what will happen in the real economy now, because it's no longer as easy for them to do through 2010 and like end of 2014. The S&P 500 has got a trend line on it that's so unnatural and so unbelievably weird that anybody who looks at that and claims that that wasn't the product of all of the various ways in which these financial markets in the West in particular have been elevated, I got a bridge in Manhattan I'd love to sell you, and I'll give you a great deal on it.
All right, well, it sounds like a good place to wrap the show there this week. We'll put the Craigslist spot for Eric's Manhattan Bridge up in the bottom.
I'll give you the Brooklyn Bridge for $10. I'll take $10 for it.
We'll put the sale instructions up at the bottom of Eric's write-up here this week. Anybody interested in it? All right, so it'll be interesting the second half of this afternoon here. If we do see gold continue to claw back some of its losses from this morning. Same thing with silver too, as we wrap up the show about 2 p.m. Eastern here. Silver.
Yeah, I mean, if silver is able to not just trade horizontally, which is what it was doing after the raid, going into the London PM fix. And by the way, we should actually make a note about that as well. Pretty darn fishy that, in the London PM fix, we get the almost nadir, and that probably is related, and again, we can't prove this, but that probably also was related to the physical stress that's in the market. And the PM fix is the most important price in the 24-hour period worldwide for setting the clearing of physical trades. And it most likely was the case that COMEX was bombed, paper bombing in COMEX, to effectuate the PM fix being set much lower. Because we really didn't see London fall apart until New York opened. And that's not an accident.
And we'd seen, I don't think we've discussed it yet, we'd seen another massive buildup in the commercials net short positions in silver. So it really wasn't that surprising at all that we saw the.
And you're speaking, and again, for people who don't follow stuff on a day-to-day basis, Doc is talking about the COMEX. Buildup of the net short position on the COMEX. So, again, we're seeing the COMEX being used as the main tool this time around to most likely explain what we see in silver today in the red.
It'll be an interesting last couple hours of trading here in the electronic access markets. Gold's already clawed back half of its losses from the day, Eric, so
that's right.
We'll see if silver starts to do the same here this last couple hours.
Yeah, and silver is always more volatile to the downside as well, and that's normal, but they also use silver as a means by which to try to change psychology because it's easier to manipulate. Even Andrew Maguire talked about the quote-unquote silver signal in his testimony to the Commodities Futures Trading Commission. What was that, back in 2010? I mean, this is reality. This isn't conspiracy theory. These things happen, and since we're recording this and it won't be broadcast until Saturday, I'm very happy to say that, if we're able to get over $14.90 on a closing basis in the aftermarket on the end-of-day trade today and Friday, that would be amazing. It would confirm what, in fact, has already happened with gold as well and recapturing some of the lost ground. So that's what I would look for. People will be hearing this on Saturday morning. And in the rear-view mirror, take a look, see what happened. That if silver is over $14.90 spot basis, that would be very impressive, given all the carnage that has happened, and it would speak to a shorter period of time necessary for the healing of the damage done. But regardless, we're going higher because everything in the conventional financial world is falling apart slowly. It's not, some mega crash is going to happen overnight. It's not because, the GTO20 is meeting and it's happening in China and we're going to see some major change happen as a result on the political front. No. It's too early for that kind of stuff right now. It may happen later in terms of super fast down moves and things flying out of control and giant downdrafts in all different financial markets and precious metals flying higher. I don't think that scenario is anywhere in our near-term prospects, but it could still happen in 2015. I've been on record as being more in the camp of the slow-motion crash with punctuated downward spikes in terms of how I think the character of this overall bear market decline would unfold, and that forecast of mine goes all the way back to the fourth quarter of 2014. The markets are confirming what I've been looking for, generally speaking, and I think that's where we're going to continue to move. And that the ultimate end game is one of a process rather than some kind of crash down moves. And some of the pundit community has been starting to get in that direction as well too. I've noticed Charles Hughes Smith, for example, last week was it last week? Maybe memory doesn't serve. It may have been actually this Monday, with a nice article, and it was published on Zero Hedge, and I think we carried it as well too, talking about that very scenario. The generals fighting the last war in terms of the analysis of the whole financial market crash scenario, thinking that we're going to repeat 2008, 2009. And the final the drawdown may in fact look a little bit like that. But I think the higher probability scenario is that we just have a slow bleed of significant pain in 2016. by the time we get out of 2016, I fully expect the S&P 500 to have more than halved from its absolute high, and that puts us pretty darn low from where we are now. Hundreds and hundreds of points below where we are. 1,100 on the S&P 500 is something that, when this whole 2016 cycle has made its trajectory through time, I wouldn't be surprised if we see that area, generally 1150, being targeted and tested.
So on that note, go grab another cup of coffee and another couple donuts.
and maybe a six-pack of beer or something, a good wine.
Started early today. All right.
As Turd would say, your favorite beverage, your favorite cold beverage.
Turd already would have cracked one open if he was with us here today.
Yeah, he'd be swinging as we were recording. So.
All right, we'll end this week's show there on a light note. So for the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.